Welcome back to the channel, everyone. If you're new here, we're all about helping you navigate personal finance and make smart money moves in today's wild economy. Hit that subscribe button and ring the bell so you don't miss our weekly breakdowns. Today, we're diving into a red-hot topic: why is gold soaring? The price of gold has skyrocketed over 31% in 2025, hitting near record highs. But what's driving this surge? And more importantly, should you invest in gold right now to protect your wealth? We'll unpack the reasons behind gold's rally, what it means for the US economy, and give you 3 practical tips to decide if gold is right for your portfolio. Let's get started. First, let's talk about why gold is on fire. Gold prices are closing in on historic highs, with spot gold trading around $2,500 per ounce in mid-2025, up 31% since January, according to Bloomberg. That's a massive jump, outpacing stocks and bonds this year. So, what's fueling this? The biggest driver is uncertainty in the global economy. The US is grappling with a $34 trillion national debt, and agencies like Moody's and Fitch have downgraded the US credit rating, raising fears of a debt crisis. When trust in government bonds or the dollar wobbles, investors flock to gold as a safe haven. It's no coincidence that gold spiked during past crises, like the 2008 financial meltdown or the 2020 COVID crash. Another huge factor is the Federal Reserve's recent moves. In 2025, the Fed cut interest rates by a quarter point, with more cuts expected, per Reuters. Lower rates make gold more attractive because it doesn't pay interest like bonds or savings accounts. When rates drop, the opportunity cost of holding gold falls, so investors pile in. Plus, the Fed's pivot came as inflation stabilized at around 3%, but fears of tariffs, like Trump's 25% on Canadian and Mexican goods, are stoking worries that inflation could spike again. Gold thrives in these environments because it's seen as a hedge against rising prices. Historically, gold gained 25% during the high inflation years of the late 1970s, and we're seeing similar vibes now. Geopolitical chaos is also pushing gold higher. Tensions in the Middle East, trade spats with China, and retaliatory tariffs from Canada and the EU are creating a perfect storm. Investors globally are nervous, and gold is their go-to asset when the world feels shaky. Central banks are in on it too. China and India bought over 1,000 tons of gold in 2024, per the World Gold Council, to diversify away from the dollar. This demand is keeping prices elevated. Add to that the recent port strikes in the US, threatening supply chains, and you've got a recipe for more uncertainty, which gold loves. But it's not just big picture stuff. Retail investors, you and me, are jumping in. Gold ETFs like SPDR Gold shares saw inflows of $1.2 billion in Q2 2025, per Morningstar. Crypto volatility, with Bitcoin dropping 10% in July, has also pushed some investors back to gold as a more stable store of value. Even posts on X are buzzing about gold as a safe bet amid tariff fears and market dips. The Dow dropped 4% in April 2025, its worst month since 2020, and gold became the shiny alternative for nervous investors. So, should you invest in gold now? Let's weigh the pros and cons. On the pro side, gold's a proven hedge against inflation and uncertainty. With tariffs potentially adding $1,300 to household costs in 2025, per the Tax Foundation, gold could protect your purchasing power. It's also a diversifier. Unlike stocks or bonds, gold often moves independently, so it can stabilize your portfolio during market crashes. In 2020, when the S&P 500 tanked 34%, gold rose 25%. Plus, it's liquid. You can buy or sell gold easily through ETFs, coins, or bars. But there are risks. Gold doesn't generate income like dividends or interest, so you're betting purely on price appreciation. If inflation cools faster than expected or the Fed hikes rates again, gold could stall. It's also volatile. Prices dropped 10% in a single month back in 2021. And don't forget storage costs for physical gold or management fees for ETFs, which can eat into returns. Some ex-users argue crypto or real estate are better hedges, citing gold's lack of yield. Plus, if the economy stabilizes and stocks rally, gold might underperform. The S&P 500 has outpaced gold long-term, averaging 10% annual returns versus gold's 5% over the past 50 years. Let's talk about the US economy context. Gold's surge signals worry. The $34 trillion debt and rising interest payments, projected to hit $1 trillion annually by 2030, per the Congressional Budget Office, are red flags. Trump's tariffs could spark a trade war, slowing GDP growth to 2.7% in 2025, per the IMF. Meanwhile, consumer confidence hit a 12-year low in 2025, per Reuters, as people feel squeezed by prices. Gold's rally reflects these fears, but it's not a crystal ball. If the Fed manages inflation and trade tensions ease, gold's momentum could fade. Now, how can you approach gold as part of your financial plan? Here are 3 practical tips. First, consider your portfolio allocation. Experts like Vanguard suggest keeping 5 to 10% in gold or precious metals to diversify without overexposing yourself. For a $10,000 portfolio, that's $500 to $1,000 in gold. ETFs like GLD or YAO are easy ways to start, with low fees and no storage hassles. Physical gold, like coins or bars, is another option, but you'll need secure storage, which costs about 1% annually. Avoid overinvesting. Gold's a hedge, not a get-rich-quick scheme. Second, time your entry carefully. Gold's up 31% this year, so it's pricey. Some analysts, like those at Goldman Sachs, predict gold could hit $2,700 by 2026 if rates stay low, but a short-term pullback is possible after such a run. Consider dollar cost averaging, buying small amounts monthly to spread out risk. For example, invest $100 a month in a gold ETF rather than dropping $1,200 at once. Check platforms like Kitco for real-time prices to spot dips. But don't try to time the market perfectly, even pros get that wrong. Third, balance gold with other assets. If you're worried about inflation, Treasury inflation-protected securities, or TIPS, adjust with CPI and offer small yields. Real estate or dividend stocks can also hedge inflation while generating income. If you're younger, lean towards stocks for long-term growth. Gold's better for older investors or those nearing retirement who want stability. Use free tools like Morningstar's Portfolio Tracker to see how gold fits with your stocks, bonds, or crypto. And always keep a cash emergency fund. Gold's not for everyday expenses. So, is gold a must-buy now? It's a strong option if you're worried about inflation, tariffs, or a market crash, but it's not a one-size-fits-all solution. If you're diversified and have a long-term plan, a small gold allocation could make sense. But if your portfolio's heavy in stocks or you're banking on quick gains, you might want to hold off. Gold's soaring because the world's nervous, but it's not a magic bullet. The key is aligning it with your goals and risk tolerance. That's the deal on gold, folks. It's shining bright, but investing smart means knowing the why and how. Drop a comment below. Are you buying gold, or are you sticking with stocks or crypto? Let's talk. If you found this helpful, give it a thumbs up and share it with someone who needs to hear this. Subscribe for more tips to protect your money, and I'll see you next week. Stay savvy, stay safe, and let's keep building wealth together.